Every time loan interest rates shift, every time inflation rises, and every time new currency enters the economy, one institution acts quietly behind the scenes, shaping the foundation of our financial lives. The Reserve Bank of India, also known as RBI. But what exactly is RBI? Is it just another bank, or something much bigger? How does one institution impact banks, loans, inflation, interest rates, and even the entire nation's economy? Today, we'll break down RBI in the simplest way possible. Welcome to MintMind, where banking, insurance, and finance become simple, clear, and relevant. Let's begin. RBI stands for Reserve Bank of India. It is the central bank of India, established in 1935. Unlike a regular bank, RBI doesn't deal directly with everyday customers. Instead, RBI controls and manages the country's entire banking and monetary system. That's why it's called the Bank of Banks. Nearly every major bank in India is regulated by RBI. Its main objectives: maintain economic and financial stability, control inflation, and ensure smooth banking operations. Think of RBI as the brain of India's financial system. Just as our brain coordinates bodily functions, RBI coordinates the flow of money across India. One of RBI's most important roles is currency management. RBI controls the printing and circulation of Indian rupees. But RBI can't just print unlimited money. Printing too much causes inflation. Imagine, if too much money enters circulation, prices can surge for goods and services. That's why RBI carefully regulates how much money enters the economy, maintaining balance and stability. Now, let's understand inflation, one of RBI's biggest responsibilities. Inflation means prices rise over time. For example, if a burger costs 100 Indian rupees today and 120 Indian rupees next year, that's inflation. A little inflation is normal, too much can be dangerous. People's purchasing power drops, life gets expensive, businesses suffer. RBI tries to keep inflation in check. One major tool is interest rates. When inflation rises sharply, RBI may increase interest rates. Borrowing becomes costlier, spending slows, and inflation pressure reduces. This balancing act is at the heart of RBI's job. A term you often hear in news is repo rate. The repo rate is the interest RBI charges when lending money to commercial banks. If RBI increases repo rate, bank borrowing becomes expensive, loans cost more, and spending goes down. If RBI decreases repo rate, loans become cheaper, businesses borrow more, and economic activity increases. So, repo rate is a powerful lever for RBI to control India's economy. RBI also supervises and regulates banks. This keeps trust in the banking system strong. Imagine banks operating without rules. Risks like fraud, instability, and unsafe lending could threaten financial security. RBI sets guidelines banks must follow, checks their financial health, lending practices, cash reserves, and risk management. This protects customers and ensures stability. Besides regulation, RBI supports economic growth. In slow periods, RBI may reduce interest rates to encourage business expansion, investments, and consumer spending. When inflation is high, RBI tightens money supply to stabilize prices. RBI constantly balances growth with stability. Every decision touching millions of lives. Even if you don't deal directly with RBI, its decisions affect your daily finances. RBI influences loan MIs, home loan rates, fixed deposit returns, inflation, banking safety, and economic stability. So whether you're taking a loan, saving money, running a business, or simply shopping, RBI impacts your finances. Let's recap. RBI is India's central bank, managing the banking and monetary system. It regulates currency supply, controls inflation, sets interest rates, supervises banks, and supports economic growth, using tools like the repo rate. RBI is vital for financial stability in India. Enjoyed today's explanation? Subscribe to MintMind for simple daily videos on banking, insurance, and finance. Comment below and let us know which finance topic you'd like explained next. Thanks for listening. We'll see you again soon.